Welcome back to Canadian Expats. I'm Serge. I'm a certified financial planning professional licensed in Ontario, Canada, and I've previously covered the tax on Canadian dividends and interest that is going to Canadians that are living abroad in another tax jurisdiction. But what happens when you sell a Canadian stock or a mutual fund for a profit? Today, I'm explaining how capital gains from the sale of stocks or mutual funds are taxed in the hands of non-resident Canadians who are considered tax residents in a different country. Basically, I'm looking to answer the question, does Canada take a cut of your capital gains and how is it taken? But before I start, I want to just give a disclaimer. While I am a certified financial planner, this video is for informational purposes only. It is not personalized tax advice, and I am not a tax lawyer or accountant, and I am not your financial planner. So always consult a cross-border professional for your specific situation. First, let's do a quick recap and explain what a capital gain is. Capital gain is just profit. You bought a share of XYZ company for $10 and you sold it a year later for $15. That extra $5, well, that's your gain. That's your profit. Simple. In Canada, for a resident, only 50% of that profit would be taxed. So that would be $2.50 would be taxable income. But for non-residents, the rules do change dramatically. Now, this is good news, which is different from dividends, where the dividends do have the withholding rate. But when a non-resident expat sells most common publicly traded Canadian investments, like shares of a company or units of an ETF or units of a stock-focused mutual fund for capital gain, well, generally, Canada does not apply a non-resident withholding tax on that gain itself. The entire profit goes straight to you. Think of it like a free pass on the Canadian tax toll road for stock profits. The Canadian government basically says, since you're not a resident, we trust your home country to collect the tax on this international income. Your gain is likely taxable in your country of residence, like the US or the UK, and Canada steps back to avoid any double taxation. Now, there is a small twist, mainly for mutual funds. Sometimes, a Canadian mutual fund that's a trust will sell one of its own properties for a big gain and then pass that money to you. This is called a capital gains distribution. In very specific, complex situations, especially if the fund holds a lot of Canadian real estate or other taxable Canadian property, a withholding tax might apply to that distribution. But for most regular stock and bond funds, when you sell the unit, you get that zero withholding free pass. This zero withholding rule is great, but it does have one huge exception, and that is Canadian real estate. If you sell a Canadian condo or a house for a profit, the tax rules do change entirely. That's where the complicated Section 116 process, where the buyer holds back money, comes into play. That complex topic does deserve its own video, and I promise to have one out for you in future releases. But be warned, the free pass does stop working if the asset you are selling is considered taxable Canadian property, even if it's not raw real estate. Here are three quick exceptions. Number one, shares of a private Canadian corporation. If you sell shares of a private Canadian company and that company's value was primarily derived from Canadian real estate or resource property at any point in the last 5 years, the gain is taxable in Canada. Number two, significant holdings in a public corporation. If you and your related family owned 25% or more of a public Canadian corporation at any time in the last 5 years, the gain can become taxable in Canada if the company's value was primarily real estate based. Number three, property used in a Canadian business. If the stock or asset you sold was part of a business you were carrying on in Canada, the resulting capital gain will be considered taxable here. So, the takeaway is this. Selling your regular Canadian stocks or mutual funds for a capital gain as an expat usually means 0% Canadian withholding tax on the gain. But once again, while this rule is widely applied, always remember our disclaimer. Tax treaties, specific investment types like private shares, and your residency status can create unique wrinkles for you. So never make investment decisions without professional advice. If this helped, hit the like button, subscribe, and check out my videos on dividends and interest tax linked in the description below.